Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in this 40th CPE program organized by AASB of ICI. Today, the very important topic, that is the standards on review engagements, SREs, we are going to cover. Your AASB has already covered all these standards this year after March 2022. And this is our 40th CPE program. And today we are going to cover SRE 2400 revised, that is engagements to review historical financial statements, and SRE 2410 review of interim financial information performed by the independent auditor of the entity. In order to tackle these two important SREs, we are having with us two important eminent speakers, CA Jitendra Agarwal ji and CA Mukul Bundal ji. So on behalf of AASB of ICI, I give you warm welcome to both the speakers. Welcome to you, sir. Welcome. We are having with us our Honorable Central Council Member, CA Raj Chawla ji, Vice Chairman of Direct Tax Committee and Vice Chairman of CMIB. So I welcome you, sir, in this AASB program. So we are fortunate enough that Honorable Central Council Member CA Raj Chawla ji has given his kind time for sparing his time for his keynote address. So without wasting much more time, may I request CA Raj Chawla ji for his keynote address. Over to Raj Chawla ji, please.
Thank you, Cost Accountant Anil Lalji, for giving me this opportunity. First of all, I am thankful to the Auditing Assurance Standard Board of ICI for giving me this opportunity to give the keynote on today topic standard on review engagement. And first of all, I am thankful to CA Sanjeev Singhal ji, Chairman of this committee, and CA Vishal Doshi ji, Vice Chairman of this committee, for giving this opportunity. And I also welcome CA Jitendra Agarwal ji from Deloitte as a guest speaker, and CA Mukul Bindal ji from SR Botley as our guest speaker. So friends, today we are going to cover SRE 2400 and SRE 2410. And this SRE 2400 revises, this standard applies when a practitioner who is not auditor of entity's financial statement is engaged to perform review of historical financial statement of entity. This standard does not address a review of an entity financial statement or interim financial information performed by a practitioner who is auditor of entity's financial statement. This standard deals with various responsibility of practitioner for review and form a content of review report. This standard provides limited assurance. The standard requires practitioner to perform primary inquiry and analytical procedure to obtain sufficient appropriate evidence as to the basis for a conclusion on financial statement as a whole. If practitioner become aware of a matter that causes him to believe financial statement may be materially misstated, standard requires practitioner to design and perform additional procedure as considered necessary to be able to conclude on the financial statement. And friends, on SRE 2410, the definition of interim financial information is financial information prepared and presented in accordance with an applicable financial reporting framework and comprises either a complete or a condensed set of financial statement for a period that is shorter than the entity's financial year. This standard applies to review of interim financial information performed by the independent auditor of the entity. This standard does not apply to review of interim financial information performed by a practitioner who is not the auditor of the entity. In such cases, the practitioner is required to perform review in accordance with SRE 2400 revised. This standard deals with various responsibility of the auditor for review and the form and content of review report. The objective of this engagement is to enable the auditor to express a conclusion whether on the basis of review anything has come to the attention that causes him to believe that the interim financial information is not prepared in all material respects in accordance with an applicable financial reporting framework. The objective of this engagement is significantly different from audit. This engagement does not provide a basis for expressing an opinion whether the financial information gives a true and fair view or is presented fairly in all material respect in accordance with the applicable financial reporting frameworks. So friends, we will cover these two SREs. So now once again to Anil Lalji.
Thank you so much, sir, for wonderful address and covering both the SREs in a very short manner, in a gist manner. Thank you so much, sir, for sparing your valuable time. Thank you so much, sir. Now moving on towards the technical session 1, that is SRE 2400 revised, engagements to review the historical financial statements. In order to tackle this very important technical SRE, we are having with us CA Jitendra Agarwal ji. It is my proud privilege to share with all of you the brief profile of CA Jitendra Agarwal ji. CA Jitendra ji is a partner with the audit and assurance practice of the firm and is based on the Deloitte office in Gurugram. Jitendra ji has a post-qualification experience of over 34 years with over 22 years as a partner with Deloitte. He is currently a member of Deloitte with coordinating board and lead various initiatives for Deloitte Haskins and Sells. As a lead audit partner for some of the firm's largest clients, Jitendra ji has been responsible for the audit of several domestic and multinational companies spanning across multiple sectors, mainly automobiles, energy and resources, technology and media, manufacturing and consumer business. In addition, he is an advisory and quality control partner on various other large clients of the firm. Jitendra ji has an in-depth knowledge of experience of reporting under various regulatory frameworks, including Indian GAAP, IFRS, US GAAP, and those of other significant capital markets. He has worked extensively on financial statements audit carried out under the requirements of the Public Company Accounting Overseas Board, PCAOB, with record of clean inspections. In addition to audits, he has managed various assignments in other areas, including internal audit, internal control, forensic reviews, due diligence reviews, and agreed upon procedures. He has extensively advised companies, including public sector undertakings, on IFRS implementation and conversions. He has been a member of the Accounting Standard Board and Auditing Standard Board of the ICI. He has also been a speaker of ICI and other industry forums and has been a faculty of IFRS course conducted by Institute of Chartered Accountants of India. Once again, welcome you, sir, on this very important VCM. We have with us CA Mukul Bindal ji to cater SRE 2410, that is the review of interim financial information performed by the independent auditor of the entity. He is a chartered accountant and BCom honors, having more than a decade experience in auditing. Currently, he is working as a senior manager with one of the reputed organizations and having expertise in power sector and experience of working of diverse industries like manufacturing industry, retail, oil and gas, finance sector, etc. So once again, welcome to you, Mindal sir, in this important VCM. So moving towards our first technical session, may I request Jitendra ji to please deliberate on the topic. Over to Jitendra ji, please.
Thank you, Anil ji. Thank you so much. Thank you, Mr. Chawla, for setting up the backdrop for this meeting. This is a very, important topic on review engagements, and both CA Mukul Bindal and I will be covering different aspects. At the outset, Mr. Chawla has given a very good background of SRE 2400 revised, which is that this review assignment is to be carried out by the practitioners who are not auditors. This situation does come up, but not as frequently as the situation comes up when the practitioners are auditors, which will be covered by CA Mukul Bindal, because that is a more frequent review report which is covered by the practitioners and which is done mostly for listed companies, whether equity or debt listed companies, depending on what is the frequency of reporting. However, having said that, SRE 2400 revised is also important in case somebody needs to do a review of financial information, which is required to be done not by the auditor. And these situations do arise. Let me just give you a brief backdrop. These situations do arise when we are not auditors, and an entity says that they want a review done by a chartered accountant, and they want it covered. There are certain laws which will require you to do that, or a company may need it for a specific reason to be for the accounts to be presented to either one of the shareholders or anybody else who is interested in understanding the company better. Not so frequently as I said, but the situation does come up. I have a brief presentation which I will present. But also, let me tell you one more thing. This review is like a normal review that is carried out under SRE 2410. Same principles apply, same ethical standards apply. The level of work is the same. The nature of the report is primarily the same. So what I would say is that this is not a very, very different standard. So don't get overawed. But the point is that, yes, since there is a guidance on the institute, there is a standard. So this has to be followed the way it is. Having said that, I'll just give you my brief presentation. Just give me 1 minute. I'm not very good at technology, but I'll try my best to upload my presentation. Is my presentation visible to everybody?
Yes, sir. Yes, sir. Make it full screen, sir.
I'm trying to do that. Yes, it is.
Yes, yes, it is fine, sir. Fine, sir. Fine.
So I'm very proud of myself. I've never done this before because I've already got my office technology people or some young kids sitting with me and they do this for me. So I've taken a full class on this and I've successfully been able to upload this now. So with this, I start. So as said, Anilji, how much time do I have? I can speak endlessly. It's 3:40. So
yes. You can go up to, sir, 4:30 or 4:35.
Okay, so I'll go up to 4:25 and then I open it for question answer.
Okay, sir. Fine, sir. Fine, sir. Fine.
So the purpose of the reviewing the financial statements is to obtain limited assurance that the financial statements or financial results, as the case may be, are free from material misstatement. So that the practitioner can conclude whether anything has come to his attention that these are not prepared in accordance with applicable financial reporting framework. The applicable financial reporting framework could be any framework. It could be the Companies Act, it could be SEBI, it could be IRDA or whatever, or the RBI rules. So it depends upon which financial reporting framework one is working under. So this is the primary thing. The scope is the practitioner may be, he may be required to comply with legal or regulatory requirements, which may differ from requirements established in this SRE. While the practitioner may find aspects which are helpful, it is the responsibility of the practitioner to ensure that there is compliance with legal, regulatory, and professional obligations. So that is the requirement of the practitioner to ensure. The scope is to review the financial information in context of the audit of financial statements of a group of entities. So the requirement is to review the information, and review what it means, we'll come to that as we discuss it later. The standards on quality control deals with the firm's responsibility, and the practitioner has to ensure that he complies with the standards on quality control to ensure ensure that he maintains the system of quality control for all assurance engagement. The same quality control standards apply to the review engagement as well. So I have just put these in a small slide which says what are the requirements that we have to comply with. I'll start from the right side. This is acceptance and continuance of client relationships and review engagement. So the most important thing is whether we need to accept a client or we need to continue with a client that we're already working on. So the practitioner has to apply his judgment whether the client is worth accepting or not, and then accept the client. So similarly, in case of continuing clients, one has to see that whether a client needs to continue or we need to drop a client as we do the review. In case of a statutory audit client where we are auditors, there we have to do a review because we have accepted the client as a statutory auditor under the Companies Act. But where the statutory audit is not there, and this standard applies to clients where we are not statutory auditors, so one will have to see that the proper acceptance procedures as required to be applied under the institute's rules are are applied appropriately. The next requirement is that the quality control standards are met. So there are multiple quality control standards, like in terms of carrying work, whether the practitioner has appropriate staff to do the work, he will spend the appropriate amount of time. He'll maintain all the other quality control standards. So this is also to be maintained. Now this is similar as in the case of audit or as in the case of any other review requirements where the practitioner is required to issue a report. The next requirement is of professional skepticism and professional judgment. So the auditor has to apply appropriate professional skepticism and always challenge as if something has gone wrong or what would go wrong, and apply appropriate professional judgment and test the estimates that the client has used to prepare the financial information. So in that, there has to be appropriate professional skepticism and professional judgment. Certainly, needless to say that the ethical requirements as required by the Institute of Chartered Accountants, as outlined in our code of ethics, have to be maintained. These are very important. These are the bedrock for any review engagement that we do, and we comply with the required requirements and the appropriate fieldwork is carried out. Then the last requirement is conduct a review of the engagement in accordance with the SRE, which is carrying out the fieldwork, carrying out the testing, the procedures as required by the SRE. So these are the broad requirements of the standard. Now, in terms of the terms of engagement, so in terms of whether we need to accept an engagement, so as we accept an engagement, these are terms of engagement which have to be agreed with the client, and the auditor, the practitioner, has to be satisfied that the client and the professional must give their consent to the terms of the engagement. This is in terms of the engagement letter that is signed with the clients. These need to be recorded in terms of an engagement letter or whichever suitable format, and have to be agreed to by both the parties. Signed by the auditor, the engagement letter is normally signed by the auditor and counter signed by the client to kind of give his acceptance to the terms of engagement. Now, what do the terms of engagement contain? The terms of engagement contain broadly the objective and scope of the review arrangement. So this is important. The objective, what is the objective of the review engagement? That has to be spelled out. Under which law it is being done? Is there a specified law under which one is covered? Is there a reason for which this engagement is being carried out? Then the applicable financial reporting framework, whether it is Indian GAAP, it is IFRS or any other, or US GAAP. So that financial reporting framework has to be specified, that the information will be prepared in a certain format and the review will be carried out in that particular financial reporting framework, under that framework. If this is not set out, certainly, there'll be a disagreement between the practitioner and the client. What is the intended use and distribution of the financial statement? What is this required for? So that is got to be spelled out in the engagement letter. And if there is any restriction on use, that is also to be spelled out. The practitioner may not want this to be a general purpose statement. He may be issuing it to the company or to the, I would say, auditee, for lack of a word, auditee, that, these are the reasons why I'm issuing it to you, and that this should not be quoted outside. If it is to be quoted outside, then this may require the permission of the practitioner. So if there are any restrictions on use, that should be brought out. The responsibilities of the management should be included. The responsibility of the management primarily includes that he should be responsible for understanding the framework in which the review is being carried out, in which the statements have to be prepared, and that it is the responsibility of the management to prepare the statement. It is their responsibility to ensure that the statements are showing a true and fair picture. So the total responsibility of the management has to be spelled out in the engagement letter. Now, all these things which I'm saying are important from the perspective that if there is any dispute on any of these, then the entire work which is done gets into jeopardy, because by the time the practitioner does the work and the client looks at the work to be done, he may not agree on certain matters being done. So all this has to be agreed upfront. A number of clients, at times say that it is not my responsibility to prepare the statement. It is your responsibility to prepare it and audit it. So that is what has to be made very clear to the client in terms of the engagement letter. Then the next is reference to the expected form and content. So what we have to set out is what is the form and content in which the report is to be issued by the practitioner. And there may be certain circumstances in which the report may differ. For example, if certain information is not available, the auditor may need to modify the report or draw an emphasis. So that has to be clarified to the client upfront. We also have to say that in the report is that the statement that the engagement is not an audit and the auditor does not express an opinion. This, as we are all aware, the scope of a review and the scope of an audit varies significantly. So this is something which is very important, that we should make it clear that this is not an audit. We will not issue an opinion. We will be issuing a limited assurance report to the auditee, which will be giving a negative assurance. So these are some of the things that we need to bring out. We have set out a specimen of an engagement letter. It is a standard engagement letter. I would not like to bring it here, but it is there. I'll show it to you at the end of the presentation. Now comes the next step after having agreed the engagement, modalities with the client. The next step is to carry out the engagement. So how does one do the engagement? The review engagement is not very different from, the planning process is not very different from the way we do an audit. Certainly the rigor in an audit is much more. There are many more tests which get done. The reports are much more detailed. But here, the practitioner shall determine the materiality for the financial statements and apply this materiality in designing the procedures, because all the account balances may not be material. Some of them may be material, some may not be material. So one determines the materiality for the overall financials at the overall financial statement level and applies the materiality, and then decides the procedures in evaluating the results obtained from these procedures are in for evaluating the results from those procedures. In case there are events which an auditor gets to know while doing the review, that there are results which will revise the financial statements for certain reasons, and those are significant to the financial statements, then the materiality may need to be revised. So to start off the audit, it starts from defining the materiality of the audit. Even the auditors, the practitioner's understanding should also include his industry, regulatory, and other experience, including the financial reporting framework. This is important because the practitioner has to understand the industry, regulatory, and other requirements to carry out a review. Each of these factors are very important as a review takes place in determining what would be the factors which will influence and which we will count upon for the purpose of his review. The practitioner has to understand the entity's accounting systems and the accounting records. So there may be not only the accounting systems, even the structure of the company. There may be multiple units in a company. How the whole accounting is assimilated, or I would say the combined financial statements are prepared. There may be subsidiaries. There may be different packages being used. The accounting software is very important. So one has to look at the entire accounting system, the control process which the company is employed to ensure that the results which are produced and the way the entries are recorded do not result in any misstatement in the financial statements. So the accounting systems, accounting records, processes, the responsibilities, the management, I would say the appropriate people are there in the management to do the work. All that is to be understood in detail by the practitioner. Then even the selection of the accounting policies, whether the accounting policies have been applied in accordance with the relevant CAP, in accordance with the relevant framework have been used, and that the judgments that the management has used or the company has used are appropriate. I'll take a small example here. if there is a manufacturing entity, and depreciation or stock valuation are very critical elements. So what is the method of valuation of stock which the company has taken, and what is the method of depreciation on property, plant and equipment that the management has considered? So these depend upon the use of machinery. Here is where the auditor's judgment for the relevant industry experience comes into being. There are certain industries which are very specific. For example, the airline industry, the method of depreciation may be different. Furnace industry, there may be seasonal industry. So this is where the expertise comes into being. And as part of the quality control, of the firm must ensure that the practitioners who are engaged for the purpose of the audit should have the relevant industry experience. Otherwise, they may not be able to do justice to their work. So the applicable policies have to be seen, the application of those policies has to be seen, nature of entity, which I've just discussed, and the materiality, which I discussed. So these are what is very critical for the understanding of the engagement team. Then comes, having done the planning process, having understood the company, having understood their accounting processes, the structure, the management, the nature of people who are engaged at various places, the competence of the employees, the competence of the staff, then comes, carrying out the procedures. Now, the procedures will primarily be inquiries of management and analytical procedures, as we are all aware in case of any review engagement. The practitioner's inquiries of management and others, this is what it will include. Accounting estimates. Now, accounting estimates are very critical, and this is where, these may change the results of a company significantly. So how has management made the significant accounting estimates required under the applicable framework? What has gone into making the estimates? There could be multiple estimates. There could be estimates on, as I said, depreciation. There could be estimates on your stock valuation. There could be estimates on obsolescence of stock, impairment of current assets, impairment of fixed assets. So how does the management make those estimates? Impairment of investments in subsidiaries or other companies. So what is the process that the management has followed to make those estimates? Are those estimates reasonable? For example, a company may make certain, investments in its subsidiaries, and the subsidiaries may be in a loss. How does the management go about making estimates whether there'll be future cash flows to ensure that the company will be able to sustain its operations and sustain its cash flows and meet its liabilities? So there will be projections which the company will make. How robust are those projections? Have the projections that are being made, they've been in line with the past estimates? So these are multiple accounting estimates, even estimates regarding employee benefits, estimates regarding gratuity and leave encashment. All those estimates have to be tested and then seen. Related party transactions. There is immense focus on related party transactions, as you may be aware. SEBI has come out with revised guidelines as to how related party transactions have to be approved and dealt with. At times, it is difficult to ascertain related party transactions, and one has to rely on management for the various related party disclosures that the company has given, particularly the names of the related parties. So this is another critical aspect, and related party transactions could have arm's length implications. If we go through the financial statements of several companies in the past, there have been qualifications around related party transactions, by modifications by the auditors on related party transactions. Related party transactions could result in the distortion of the company's results because the profits or losses could get impacted by non-arm's length related party transactions. So the identification of related parties is very important. The manner in which arm's length has been decided, has taken place is very critical, and the appropriate approvals of related party transactions. The appropriate approvals is very important because at times these have to go to the shareholders for approval, and these approvals have to be not retrospective, but these approvals have to be taken beforehand, before the transactions have taken place. So that is a critical element in related party transactions. Now, the practitioner also has to see whether there are any significant, unusual, or complex transactions. This slide which I'm discussing here is the bulk of the work that a practitioner does. So I'll spend some more time and maybe spend lesser time on the other aspects. So significant or unusual or complex transactions. Complex transactions could mean derivative transactions, taking hedges against foreign exchange earnings, taking natural hedges against commodity exports and imports. So these are certain unusual or complex transactions that could be important, that could affect the entity's financial statements. Terms of the contracts. The terms of the contracts at times define how the accounting will take place. For example, in case of a lease transaction, the terms of a contract would define whether it is a lease or it is not a lease under AS 116. So these have to be understood. There could be routine transactions, there could be unusual transactions, there could be significant transactions. So those have to be understood in detail. And how does one get to know that these are unusual transactions? This will depend upon one, discussion with the management, and two, it will depend upon a review of the significant account balances in the company's financial statements. So this is something which one has to look at, talk to management, make inquiries of management, and get an understanding of these significant unusual transactions, that these are in line with the company's processes, authorization procedures, and are genuine transactions. The other important element is the existence of any fraud in the company. If there is any fraud, then there are certain reporting requirements which the auditor is bound to communicate with the company, with those charged with governance, and maybe with regulatory authorities. One has to again examine this with a very critical eye. One has to look at the records. The practitioner may have to look at the records, the board minutes, the whistleblower registers, and anything else that will come his way to ascertain whether any fraud has taken place or are there any indications of fraud. The fraud may be, kind of unearthed. It is not the auditor's responsibility or the reviewer's responsibility to unearth frauds, but a fraud may be unearthed by the auditor or the reviewer, or it may be brought to his attention by management. Appropriate procedures have to be designed to see that that fraud has not materially impacted the financial results of the company, and that any consequences arising of the fraud have been taken care of by the management. There may be non-compliance with provisions of laws and regulations that may affect the entity's financial statements. So one has to also look for non-compliance with laws and regulations. Now, an auditor may not be aware about all laws, but any law which may have an impact on the financial results of an organization may be critical, and the auditor may need to report upon that, or may make sure that required adjustments have been made for that. If nothing is done, then he may have to have suitable modifications in the report. So these are certain things which also have to be discussed with those charged with governance, so as to bring to the attention of those charged with governance that there are elements which one has to take care of. If not addressed, then they have to be reported. Another element which is critical is events occurring after the date of the financial statements or financial results. Has the management identified any event which has an impact on the financial statements as at the year end? In terms of the accounting standard, whether it's an adjusting event. If anything of that matter has taken place, then that needs to be adjusted in the results. If not, a disclosure may need to be made to management that these are certain significant events which have taken place after the balance sheet date. Each of these matters that I brought about here also need to be addressed to those charged with governance in terms of an audit committee presentation or otherwise. I'll move on to the next slide, which is also part of the same, which is designing and performing procedures. This talks about going concern. At every period end, the going concern of an entity has to be evaluated. The management should test its going concern assumption, and the auditor should verify that what the management has tested holds good. So the company is considered to be a going concern if it has sufficient cash flows to meet its liabilities for the next 12 months. Going forward this year onwards, there is a reporting requirement in the auditor's report as well. But anyways, this is a very critical assumption and particularly applies good to companies which are financially stressed. So the auditor has to carry relevant steps to ensure that it's a going concern entity. There have been going concern failures in the past, which we are all aware about. So this takes importance in view of those failures. So this is part of the inquiry. Now I'll come to the analytical procedures. So once the inquiry is done, then the company needs to carry out analytical procedures on the account balances. Now these analytical procedures does not mean that you only look at variations in numbers between quarter to quarter or year to year. There are various parameters. One has industry knowledge. The auditor is expected to have industry knowledge. The auditor should know what would be the cost of consumption in case of a manufacturing company, what should be the utilization in case of a software company, what should be the gross margin in case of both these companies, software services or manufacturing companies, and that knowledge should be applied here. I'm not saying that one should do an audit based on the industry benchmarks, but that will help him do an audit. For example, if in a software industry, the utilization is 80% and some companies giving 60%, one needs to inquire as to why that is happening. So multiple analytical procedures have to be applied on the account balances as we carry out a review. Again, obtaining an understanding of the entity and its environment, that is what I've discussed in the past in the opening slides. Identifying inconsistencies or variances expected from trends, which is what I just discussed. If there are any inconsistencies, significant inconsistencies, for example, if say in a tire manufacturing company, the cost of raw material is say 60%, or if in a hotel, the cost of food to sales is 25%, and if this cost is very high in another company, I'm not saying there is anything wrong in it, but reasons have to be understood and those have to be documented. Anything that is being done has to be documented very well. Not documented means a person has not done his work. So that's a golden rule which is set out in the accounting, in the documentation standards. Not documented, not done. So one has to obtain an understanding of the environment, identify inconsistencies or variances from expected trends, values, or norms in the financial statements, and provide evidence in relation to the analytical procedures performed. So one should document what is the evidence that one has seen for these analytical procedures that have been performed. Contractual obligations. The auditor is also required to look at contractual obligations, commitments which have affected or may affect the entity's financial statements and the disclosures, in respect to those commitments. Any non-monetary transactions or transactions for no consideration should also be looked into. So this is also forming under the unusual transactions. So these are some of the procedures that, these are some of the, points, inquiries on which the practitioner should look at as he does the review engagement. In a review, inquiry, what is an inquiry? We've talked about two things, inquiry and analytical procedures. What is an inquiry? Inquiry includes seeking information of management and other persons as the practitioner considers appropriate in the engagement circumstances. An inquiry is not an interrogation. It is just understanding how the account balances have been built up and to obtain any information for an understanding of the transaction, the underlying transaction. And this is not only for financial data, this may be for other factors also, which is non-financial. Evaluating the responses is integral. So whatever responses one gets is very critical to the inquiry process, because these responses that have been provided by management have to be to the satisfaction of the reviewer, of the practitioner, in forming an opinion on the results. Now, inquiries, this is, again, we're elaborating on the inquiries. Inquiries may also include inquiries about action taken at meetings. These are board meetings. What actions have been taken at governance committees? If there are critical matters that have been brought up to the board and the promoters and the owners, the shareholders, so one has to see as to what are the actions that have been taken on those, and if any of those actions will impact any disclosures in the financial statements. A company may have given up. If you look at the current year's Schedule 3 changes, it talks about fixed assets. It talks about capital work in progress, which has taken place. There is aging of capital work in progress, and if there are delays, as to what are the reasons for those delays. So all this comes out of inquiries and management notes, which are there in the with the management in terms of board meetings or other written documents. The inquiries could include communications the entity has received from regulatory agencies. Now, this is something which may not be available to the auditors from the books of account, but if there are any communication from regulatory agencies, it could be any of the agencies such as the MCA, such as income tax, indirect tax authorities. So all those regulatory agencies, whatever information, whatever communication has been received, that should also be brought to the notice, and that is something which the auditor should inquire upon, because that would have a bearing on the financial results. For example, if there is an income tax demand which has come, that may need a disclosure in the contingent liabilities. It may also need to be assessed whether the demand is good or not, and at what stage it is, and assessments may need to be made whether that would require a provision for tax in the financial results. The other inquiries are matters arising in the course of applying the procedures. When performing further inquiries relating to inconsistencies, if there are any, if the management considers the reasonableness and consistency of management responses, this is something which is also critical in terms of an inquiry as to how the practitioner looks at the information which is obtained and looks at the reasonableness, and then takes a informed call as to whether the information, the inquiry procedures, the information provided by management is appropriate in terms of the inquiry which has been put up to them. Now, this is about inquiry. The next is analytical procedures. How does this assist the practitioner? It assists the practitioner in obtaining the practitioner's understanding of the environment, and because of these analytical procedures, a practitioner is able to identify where the material misstatements are likely to arise. It is not possible to test everything in detail, so the practitioner has to decide what areas he has to test and in what detail. Also, the analytical procedures, as I had touched upon earlier, help a practitioner in determining, with inconsistencies arising from period to period, or in terms of within the financial statements as to how the inconsistencies are operating. I remember, one of our colleagues, as we used to do the audit, used to say, senior colleague used to say that if there are positive variances, please do an inquiry and understand why there are positive variances. If there are negative variances, obviously you'll do an inquiry and understand why there are variances. If there are no variances, then also do an inquiry, because there may be factors which may come up as to there should have been variances and there are no variances. So it depends upon what are the factors, and a lot of factors would depend upon extraneous circumstances. For example, if you've noticed in the last 2 years, significant reduction in travel expenses has taken place because of the onset of COVID. Now, these are some of the factors which you have to consider. I'm giving a very blatant one here, but these are some of the factors that you have to consider as we do our inquiry and analytical procedures. Moving further into analytical procedures, we have to seek evidence in relation to inquiry or analytical procedures already performed. Serving as additional procedures when the practitioner becomes aware of matters that cause the practitioner to believe that the financial statements may be materially misstated. An example of such an additional procedure is a comparative analysis, which I just touched upon, of monthly revenue and cost figures, profit centers, branches, etc. So these are certain evidences which a practitioner has to look at. Going concern, I touched upon this earlier. Going concern. 1 minute. A review, going concern is the fundamental basis on which the financial statements of an entity are prepared, and this is an underlying assumption that the entity will continue as a going concern. The management has to confirm that the entity will be able to continue as a going concern, and the auditor has to test that assumption by carrying out various procedures that the entity will consider to will continue to operate as a going concern. Now here this may normally arise in situations where the entity is suffering a loss or the entity's financials are stressed. It may also arise in a situation where an event has taken place which may cause the auditor to comment on going concern. Years back, there was a fire in a factory which was there post balance sheet. So one had to make a determination, which was during the year. So the auditor had to take a call whether the plant will be able to continue as a going concern or not. And it was fairly evident that the plant would not be able to continue as a going concern because there was significant damage to the critical element. So there could be even regulatory instances where going concern may get challenged, despite the company having a robust financial, I would say, background. So this is to be evaluated and a very critical assumption. And the auditor also has to communicate with those charged with governance that there are no factors which cause the company to not be a going concern. Related parties, we just touched upon it. One has to look at, the practitioner has to look at all the arrangements for related parties, look at whether these are at arm's length. Also testing whether there are related parties which have not been disclosed. If there are indications for that, one has to look at it, and there are multiple ways and means by which this can be found out today. Again, an auditor does not have to be a practitioner, does not have to be a bloodhound, but he has to use his own judgment and be very alert to his judgment to see that there are no related parties which have got hidden. Also look at the arm's length transactions between the related party and the entity being audited. So these are very critical, and the relevant appropriate, I would say, approvals should also be checked for all related party transactions. In addition to that, there are some disclosures which have to be made. Those disclosures should be in accordance with the law under which the review is being carried out. If the practitioner identifies transactions which are outside the normal course of business, then he should inquire about the nature, whether the related parties could be involved, and the business rationale. Now, the last point here is very critical. One may see a related party transaction happening, a transaction which is not related to the business. That has to be challenged. The rationale has to be looked at. We've come across cases where big chunks of money were transferred between parties, and there was no rationale behind it. So when checked, then there was a doubt on whether those transactions should have taken place or not. So these are some of the factors. Then the practitioner needs to determine how to disclose these in the auditor's report or the practitioner's report, the review report. Sorry. In doing a review, we have to use the work performed by the others in carrying out the review. And we have to take that into account as far as the work is concerned. This is also, these are, the work which is carried out by the others could be the actuaries, could be tax experts, could be other experts who have done certain work. So the management has to assess the work which has been done by the others and communicate. Sorry, I slipped a slide. And communicate that the auditor has taken sufficient steps to ensure that the work done by the other experts is adequate, and that having said that the work is adequate, the auditor has performed certain procedures to ensure that the work is complete. For example, the auditor may be using indirect tax experts, may be taking opinions from indirect tax or tax experts. One has still to exercise his own judgment. The practitioner will have to exercise his own judgment to ensure that the work performed by others is appropriate and complete. Now, coming to frauds or non-compliances, where there is an indication of any fraud or suspected fraud, the practitioner should communicate this to the audit committee or those charged with governance as appropriate. Could be the audit committee, could be the board, could be senior management. Also look at the management's assessment. The ultimate responsibility of ensuring complete control or the internal control is of the management. Then one has to look at what assessment has management done to ensure that there has not been any harm or any impact on the financial results, or if there has been an impact on the financial, that has been accounted for. We have to then request, the practitioner will have to request the management to see if there is any effect on the financial statement. For this purpose, the management may have to have a special report on that particular matter. Consider the effect of that on the financial statements, and whether if this is, or if this is something to be reported to a regulatory agency as required by by law, the auditor may need to report that as well. These are some additional procedures which need to be performed. Again, as I said earlier in my presentation, that work documented and is work not done. Now, what are the additional procedures? If the practitioner becomes aware of matters that causes the practitioner to believe that the results could be materially misstatement, then the practitioner may need to perform certain additional procedures to ensure that the results are not materially misstated, and that all the work has been done, that the accounts have been prepared properly, the financial statements are prepared appropriately. In case the work results in proving that there is a misstatement in the financial results, then that may need to be a matter of the financial report. Subsequent events we've already discussed. The practitioner should look at whether any subsequent event has an impact on the financial results. If it has, it will be adjusted. If it is an adjusting event, if not, and if it requires a disclosure, that should be taken care of by a note in the financial results, and by also communicating the same with those charged with governance. Not last but not the least, the management has to take written representations of management, that the management has fulfilled all its responsibilities in terms of the engagement and has disclosed. And there are certain matters in which the auditor has to reply on representations on certain calls taken by management, on certain documents that have been made available. So those should also be included in the representation. The practitioner shall request management to provide a written representation that management has fulfilled its responsibilities described in the agreed terms of engagement. So this is what is very critical. This should include, again, just to reiterate, that management had fulfilled its responsibilities, and all transactions have been reflected and recorded in the financial statements. If law or regulation requires management to make written public statements about its responsibilities, and the practitioner determines that such statements provide some or all of the representations required by subparagraphs A, B, the relevant matters need not be included in the management representation. Subsequent events I've discussed, don't want to discuss it at length. That if there is any disclosure to be required, adjustments have to be made, these should be done. If there are disclosures required, these should also be taken care of. The practitioner has no obligation to perform procedures regarding the financial statements after the date of the practitioner's report. Certainly, we do not have any obligations, but still, from the purpose till the date of the financial statements and the date of the report, there is a time which is there, maybe a month or 2 months. Anything that has come up to the auditor's notice should be discussed with management and appropriately dealt with. Conclusion and reporting. After all the work is done, the management, the auditor has to conclude his report. It should have a clear written expression of negative assurance. He should review and assess the conclusions drawn from the evidence which a practitioner has obtained. So based on the inquiry, based on the analytical procedures and other tests carried out by the management, as you've discussed, if the practitioner is of the view that he can provide a clean negative assurance, he should do that. If there are any reasons for him to not provide a clean report, again, that should be stated, indicating the reasons. Needless to say, all the other elements, the title, addressee, opening and introduction paragraph, the format of the report, that is defined by the SRE, and that should be in accordance with that. Now, these are the forms of the report. There is a very detailed report in the appendix of SRE 2400 revised, which one should follow for different forms of report that have to be issued. So that's all from my side, and I'm open to any questions or answers, questions that the audience may need to seek. Over to you, Anilji.
Thank you so much, sir.
नहीं तो फिर उसको पांच क्यों नहीं कवर किया संडे को?
Sir, can you hear me?
तो Thursday, Friday, Saturday है ना?
So we have managed to do it within the time allotted.
Sure. Yes, sir. Yes, sir. Can you hear me, sir?
कोई बात नहीं.
I can hear you, Anilji.
Yes, sir. Yes, sir. Thank you so much, sir, for such a wonderful deliberation, and you have covered within a time frame very, very, very important aspects. And frankly speaking, I have gained a lot through your deliberation. Hope members have also gained on this SRE. We have covered a lot of things. Due to the technical glitch, we haven't received more questions. I have one question, very important question, sir. Relating to the materiality. Member is asking, is it compulsory to determine materiality? And if the auditor and auditee are comfortable, can we do away with the materiality concept?
No, I don't think that, one has to look at the auditee's comfortable position or the auditee's acceptance. I think it is important and it is critical for us as practitioners to define materiality, because that is the basis on which our entire test or transaction, our entire inquiry and other procedures will be determined. If we do not determine materiality, the time taken and the scope will be very high, and we will not also be adhering to the standards on auditing or the standards of review engagements, which ask us to determine materiality. Very important to determine materiality.
Yes, sir. Yes, sir. Yes, sir. Sir, can we give qualification in the review report if the situation demands, even though there is no full-fledged audit of the financials?
Sorry, I couldn't understand that question.
The question is, can we give qualifications in the review report if the situation demands, even though there is no full-fledged audit of the financials?
Yes, we can give modifications. Yes, we can give modifications if we have reasons to believe that the results are not financially, they're not appropriately presented. So we can give qualifications stating why, the reason for the qualification or the modification, whichever ways. I'm an old school person, so I use the word qualification instead of modification mostly.
Yes, 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 sir. So thank you so much, sir, for your wonderful deliberation. On behalf of AASP of ICI, I extend my happiest thanks towards you for sparing your valuable time out of this busy, very, very busy schedule. Thank you so much, sir. Thank you so much, sir.
Always a pleasure, anytime. Thank you.
Thank you, sir. Thank you, sir. Moving on towards the next technical session relating to the SRE 2410, that is the review of interim financial information performed by the independent auditor of the entity. We have with us our own learned speaker, CA Mukul Bindal ji. So without wasting time, I request Mukul ji to please deliberate on this SRE. Over to Mukul ji, please.
Yeah, thank you so much, Anil ji. First of all, I would like to thank ICI committee members for giving me this opportunity to provide my thoughts on SRE 2410. And special thanks to Mr. Agarwal for sharing his thoughts on SRE 2400. So I will just present my screen. I have prepared one small presentation on this. Let me know once it is visible.
Make it full screen. Yes, sir. Fine.
Yeah. So, as most of the things are already covered as a part of SRE 2400, there are no significant differences in terms of the procedures between SRE 2400 and SRE 2410. So we would be discussing on the differences between these two standards. And this is a quick summary of what all we are going to discuss as a part of SRE 2410. So first is on the introduction and the meaning of interim financial information, which Raj Chawlaji mentioned at the beginning of this session. Then why there is a need for the separate standard if SRE 2400 is already there? Why do we need SRE 2410 when review is being performed by independent auditors? Then what are the objectives of review of interim financial information? And what is the objective of engagement? And what are the topics which are covered as a part of engagement letter when engagement letter is entered between the independent auditor and the management? Then what are the primary review procedures which are suggested by standard that would be covered? Then what is the auditor's responsibility for the accompanying information? So the information which he obtains as a part of review procedures. What is his responsibility if he comes across any inconsistency in that information with the interim financial information? Then if he finds any material adjustment or misstatement in the interim financial information, then he should first communicate to the management. So what is the communication protocol an independent auditor should use when he comes across any material adjustment as a part of his review procedures? Then we would be discussing on the form of the limited review report, what are the topics which are covered and how they should be drafted. Then there is one example of the review, many examples of the review report given as an appendix to the standard. Then the types of conclusion we would be discussing, the qualified adverse conclusion, what are the situations require such kind of conclusion. Then when there is a limitation of scope, what kind of conclusion should be given. Then when there is a going concern assessment and going concern there is an uncertainty for this going concern assumption, then what kind of conclusion should be used. Then what are the differences between review and the audit procedures? Some of the key differences I have tried to put in the slide. And the last one is documentation. So why there is a need for the documentation and what kind of documentation an independent auditor should maintain. So these would be the topics which we would be covered in discussion. And now moving to the next slide. This is on introduction and the meaning of interim financial information and why there is a need for SRE 2410. So to start, I would first tell you what is the interim financial information. There are the three characteristics which should be present for any financial information to be an interim financial information. One, this is a financial information which is presented and prepared in accordance with the applicable financial reporting framework. It can be any framework. If this is being prepared under the Companies Act, then it can be India's 34. And if it is being prepared in any other financial reporting framework, then it should be complying with that FRF. Then financial information which comprises either complete or condensed set of financial statements. So it can be a full-fledged financial statements that will also be called interim financial statement. And if it is a condensed financial statement, then it can also be called interim financial statement. Then the third important characteristic which should be there, it should be for a period less than the entity's financial year. So if it is for the complete year, then it would be year-end financial statements. And if it is for a period lesser than the complete financial year, then it would be called interim financial statement. Now, for performing the review procedures and providing the conclusion on such interim financial statement, there is a need for two standards. One is SRE 2400 and another one is SRE 2410. Now, why SRE 2410 has come into picture when SRE 2400 is already there? So for the audit engagements, independent auditor has already performed certain audit procedures and has obtained the understanding of the entity, its internal control. Now the level of review procedures he would be performing on the review engagement would be much lesser as compared to any practitioner or third party, any new auditor coming into picture performing the review procedures. So the level of procedures for an independent auditor would be much lesser as compared to any new auditor performing the review of financial information. So that is the reason SRE 2410 has been separately formed for any independent auditor to perform the review procedures on the interim financial information. So for performing the review procedures on interim financial information, independent auditor just updates his understanding through inquiry and the analytical procedures. The inquiry analytical procedures, which Mr. Agarwal just mentioned during his session, I would also be covering some of the procedures in my subsequent slides. But by performing all those inquiry analytical procedures, he would just update the understanding which he had obtained as a part of his audit procedures, which he performed during the audit of year-end financial statements. Now, the practitioner doesn't ordinarily have the same level of understanding because he's new to the organization and he would be obtaining the understanding of the entity. So for a practitioner, a separate standard is formed, which is SRE 2400 for reviewing the interim financial information. So there is a table at the bottom which summarizes which standard should be used for review of financial statements. So when there is an independent auditor and he's performing the review of interim financial information, and he has already performed the audit of previous year-end financial statements, then SRE 2410 would be used. So there may be a situation when a new statutory auditor comes into picture because of any reason, say due to the rotation of the auditor, new auditor comes in, and there is a requirement by the entity. There is some legal requirement by the entity that a review of one historical interim financial statement is to be performed, and management requests the new auditor to perform the review of such interim financial statements. Then in that case, he would be providing his report under SRE 2400 because he's new to the organization and he hasn't been involved with the client in those relevant years. So in that case, SRE 2400 would be used. So these are very rare circumstances. These situations generally arise when there are certain capital market transactions or other specific need by the management for review of previous period interim financial statements by the independent auditor. Otherwise, if any independent chartered accountant or independent practitioner is performing the review, then it would be SRE 2400 which would be used. So this is the summary why there is a need for SRE 2410. Now moving to the next slide, what are the general principles of review an independent auditor needs to follow? So I would say the first one is, there are three parts. One is the ethical requirements, second is the quality control, and the third one is professional skepticism. These are the three principles which are mentioned in the standard which an independent auditor should follow. As a part of ethical requirements, I would say these are all covered as a part of Code of Ethics issued by Institute of Chartered Accountants in India, which are forming part of Chartered Accountancy Act. So there are various sections given in Code of Ethics, say section 110 to 150, which covers all these topics: independence, integrity, objectivity, professional competence and due care, confidentiality, professional behavior. So all these topics an independent auditor should take care. Now, what do we understand by integrity? It means an independent auditor should be straightforward and honest in all professional and business relationships. Then, if we talk about objectivity, he should not allow the bias, conflict of interest, or undue influence. And if you talk about the professional competence, so if he's providing any kind of services to the management, then he should have the relevant knowledge, relevant competence to perform that particular engagement. And he should take a due care while performing such engagement, that he's not providing any wrong conclusion or wrong comfort to the management. He should be updated with the relevant updates required to perform that particular engagement. And the last one is he should maintain the confidentiality. So he should respect the confidentiality of the information which is acquired as a part of professional engagement with the management. So that is also required by the Code of Ethics. And he should maintain professional behavior. So he should not do any such act which brings any kind of disrespect to the profession. So this is all on ethical requirements, which we are all aware it is being specifically required by the standard. Second is on the quality controls. So again, on quality control also, there are various guidance available. There are various standards like SQC1, which talks about the quality standards which an independent auditor should maintain. So, and the third one is the professional skepticism. So for professional skepticism, then auditor should plan and perform the review with an attitude of professional skepticism, and recognizing that circumstances may exist that cause that interim financial information are not free from material misstatement. So he should always have a questioning mind with him while reviewing the interim financial information, and he should review each and every transaction covered as a part of his scope with a questioning mind and with the attitude of professional skepticism. So this was on the general principles of review of interim financial information. Now, moving to the next slide, which is on the objectives of the review engagement. So talking about the objectives, first we should understand how many kinds of assurances are available. So there are two kinds of assurances which are generally provided by the auditor. One is the reasonable assurance. Second is the negative assurance. So when we talk about the reasonable assurance means auditor's degree of satisfaction that evidence is obtained during the performance of audit supports the assertions embodied in the financial statement. So reasonable assurance means whatever the evidences an auditor has obtained as a part of his procedures. So basis such evidences, he can confirm that the assertions present in the financial statements are true. Now, if you talk about the negative assurance, so negative assurance is a confirmation from an auditor that certain facts are accurate because there is no evidence to the contrary. So again, in the negative assurance, auditor confirms that he has performed certain procedures as a part, as suggested by the standards on auditing. And basis such procedures, whether review procedures or other procedures, he confirms that he hasn't come across any such particular evidence which says that the financial information is not in compliance with the financial reporting framework. So as a part of our review procedures, we provide the negative assurance only. So there are many situations where this standard is used, as Mr. Agarwal said in the beginning, that there are the quarterly reviews required by equity listed or now even by the debt listed companies also. So there we use SRE 2410, and the language of the assurance and the type of assurance is which is provided as a part of our review report. That is the negative assurance, where we confirm that we haven't come across any such particular event which says that financial information is not prepared in accordance with the Ind AS 34. So the language which is used in the standard for the objective review engagements is provide negative assurance, that is enable auditor to express a conclusion whether on the basis of the review anything has come to the auditor's attention that causes auditor to believe that interim financial information is not prepared in all material respects in accordance with the applicable financial reporting framework. So this was on the objective of the review engagements. Now, if we move to the next slide, this is on agreeing the terms of engagement. So as it was explained by Mr. Agarwal as well, so there are various topics which we should cover as a part of the engagement letter. The first key area which should be covered is the nature of engagement, that it is a review engagement for a particular period, for a particular financial statement for a particular period for a particular entity. Then objective and the scope of review should also be covered, and that we are going to review the financial statements under the standards of auditing, which is standards to be used, and what would be the financial reporting framework under which the financial information would be prepared, which an auditor needs to review. Then the third is the management's responsibility, that management is responsible for the preparation and presentation of the financial information and ensuring that it complies with, so the primary responsibility for the financial information to comply with the financial reporting framework is of management. So that particular responsibility should be covered as a part of engagement letter. Then auditor's responsibility, that auditor is required to provide a conclusion on the financial information and he would perform certain procedures. So all those responsibilities of the auditor should be covered. Then the kind of assurance which is to be provided on the financial information would be covered, and the nature and form of report which would be provided, that will also be covered as a part of the engagement letter. So this was on the terms of the engagement. Now, these are the key differences between the review and audit, which I try to cover. One, in review, the level of assurance is the limited assurance, and in audit, it is limited or negative assurance. And under audit, it is the reasonable assurance, which is given by the auditor. Then the types of procedures which are performed under review and audit. So under review, the procedures would be inquiry or a limited review, and under audit, it would be TOC or TOD, the test of controls and test of details. Under review, the reporting, so we call it the conclusion paragraph, and under audit, we call it the opinion paragraph. So there is a difference between the type of reporting under review and audit. The standards to follow under review is SRE 2400 or 2410 for the review engagements, and for the audit, it is the standards on auditing, other standards. Then control opinion under review, it is not mandatory. Under audit, it is mandatory for certain class of companies. CAM reporting, so under review, it is not required. Under audit, it is mandatory for the listed entities. And for the regulatory requirements, so for review, as we mentioned initially, that for debt and equity listed companies, it is required by SEBI LODR. And for audit, it is a Companies Act requirement and the statutory requirements for performing the audit. Now, jumping to the other slide, which is on the review procedures. So most of the procedures are similar in SRE 2410 as compared to SRE 2400. But to talk about specifically what is given in SRE 2410 is first understanding the entity, including its internal control and environment. So I would say this is the planning phase. So I would divide the entire review process in three parts. One is planning, second is the execution, third is the conclusion. So in planning phase, we obtain the understanding of the entity, its environment, and its internal controls. So as a part of this, we perform procedures under three categories. One, update and obtain the understanding. So we obtain the understanding or update the understanding for the preparation of the financial statements and what are the controls present over preparation of such interim financial information. So as if we are using SRE 2410, it means that independent auditor has already performed the audit of previous year financial statements. So as a part of his planning review procedures, he would first update his understanding for the process of preparation of annual interim financial information. So he would understand whether there are any changes in the process as compared to what he had understood as a part of the audit, and if such changes are material. Then second would be he would use this understanding to determine the inquiries. So one example would be suppose he comes across that there is a change in the management as compared to the previous year, and also there is a change in the approval process for the interim financial information. Earlier approval from one authority was required. Now once financial statements are prepared and before sharing it with the independent auditor, there are two approvals required. So he would determine to whom he should address his inquiries and the type of and the level of inquiries he should be asking. If there is a change in the person preparing the financial information, then he might expect some more errors in the financial statement because there is a new person coming in. And if there is no change and no errors were found in the previous period, then he wouldn't expect so much errors. So basis understanding of the process of preparation of financial information, he can frame his inquiries and determine to what extent he need to go. So he would determine the inquiries which are to be made, the level of and the kind of analytical procedures to be performed. The procedures would be discussed in the subsequent slide. And he would identify the events, transactions, assertions to which inquiries and other procedures may be applied. So first he would obtain the understanding of the process of preparation of financial information. Then he would determine the inquiries which he need to ask. And the third is determine the nature of review procedures required for components considered. So suppose there is a large group for which a review engagement is to be performed by the independent auditor. And in such group, there are say 100 plus entities, and out of 100, the primary auditor or the independent auditor audits only 80% of the entities. And for the remaining, there is an other auditor or the component auditor who is performing the review of such components financial statement. Then he would determine what level of materiality he need to give to the component auditor to provide the comfort to the primary auditor for those components. Then what would be the risk of so he would determine the risk, materiality, and other procedures which are he needs the component auditor to perform to enable the primary auditor or the independent auditor to provide a report on the group financial information. Now, the kind of procedures which are generally performed as a part of understanding the entity, environment, and its internal control are he generally, the independent auditor generally reads the preceding year's audits or reviews of the prior interim period, like what were the difficulties or observations were there in the previous period audit or reviews. Then as a part of audit, generally, there are certain significant or fraud risks which are identified by the audit team. Now, as a part of review procedures, independent auditor would assess whether the same significant risk would be present in the review engagements or not, or if there are any changes. So he would develop the inquiries around such significant risk or fraud risk. For example, as a part of year-end audit, one of the risks which was identified by auditor was fraud risk on revenue recognition for any manufacturing entity. Now, as a part of review procedures, if he observes no change in the business of the entity, then he would carry the same fraud risk to the review engagement as well, and he would conclude that there are no changes in the business of the entity, so there would be no additional significant fraud risk in the entity. Then the third procedure, which is an example for the planning review procedures, he would determine the materiality with a reference to the applicable financial reporting framework as it relates to the interim financial information to assist in determining the nature and extent of procedures. So one question was there, why there is a need for the materiality to perform the review procedure. So on materiality, I would say some of the procedures, some of the review procedure or analytical procedures which you are performing, for example, comparison of the current year, analysis of the variation between current year numbers and the previous year numbers. So once you are analyzing it, so then it may be possible that there are n number of variations. So as an auditor, as an independent auditor, and as a part of review procedures, you are not required to review all kind of variations. So for that, you would need a materiality basis the judgment that if the variation is above this particular materiality, then the auditor would review. Else he can conclude in the work papers that it is an immaterial variation. So again, materiality is very important for the review as well as audit procedures. Then next kind of procedure is considering the nature of any uncorrected material misstatements and any identified uncorrected immaterial misstatements in the prior year. So as the first procedure was reviewing the previous audit work papers or review of previous review work papers, then he would see whether any material misstatement was observed as a part of previous engagement, and if it was corrected, then some similar kind of misstatement can be here. So he can plan his procedures around such particular area. Then next is considering significant financial accounting and reporting matters that may be of continuing significance, such as material weakness in the internal control. So as a part of the audit, if any significant accounting matter was identified by the auditor, which was concluded to be significant, and certain audit procedures were performed, then for that particular matter, he would frame his review procedures for his review engagement. So the example given this standard is the material weakness in the internal control. So if it was concluded in the audit engagement that for a particular control there is a material weakness, and management had confirmed that, had provided the deadline that by this particular time this material weakness would be corrected, then as a part of review procedure, auditor can check whether such material weakness has been corrected or not. Then considering the results of any internal audit performed and the subsequent actions taken by the management. So again, as a part of planning, he can obtain the internal audit. He can ask management whether any internal audit was performed. So if it is what it was performed, then what are the results? So he can inquire from the management what are the results of such internal audit. Then again, he can frame his inquiries to ask management whether there was any fraud observed by the management, and if it was there, then what was the result and how it impacted my financial statements. Then inquiries for effect of changes in the entity's business activities. So again, as a part of understanding the entity, this is the first question which independent auditor should ask, whether there is any change in the business of the entity. Suppose there was a change in the business model. Earlier, the company was selling the products through distributors only. Now the company has opened its own retail chain. So if there is a change in the business, then you might have to perform additional review procedures to perform the audit of revenue or other areas having an impact of such change. Then the next is inquiries for the significant changes in the internal control and potential effect of any changes on the preparation of interim financial statements. So again, the same thing, he need to ask whether there are any changes in the internal controls of the entity. If there are any changes, then what would be the impact of such changes in the interim financial information. So these are the procedures for the planning of review engagement. Now, if we talk about the execution, so for the execution, there are inquiries and analytical review procedures which an independent auditor needs to perform. So on the left side, this is the language which is being given in the standard, and on the right side, these are the examples on the review procedures. So standard says auditors should make inquiries and perform analytical and other review procedures. And the nature and extent of inquiries and analytical and other review procedures are affected by the understanding which he has performed as a part of the planning, and the result of the risk assessment related to the preceding audit. So as a part of understanding, the auditor looks back to the previous audit work papers or the previous review engagement work papers, and he sees whether there was any risk which was identified as a part of auditing the financial statement, and what were the results of such risk assessment, and if such a risk is present in currently also, then what would be the review procedures. If it was concluded appropriately and sufficient procedures were performed, then he might reduce the extent of his review procedures or vice versa. Then the third is the materiality considerations. So while determining the materiality, I would say there are two steps. One, an auditor should determine what is the basis he should use to calculate the materiality. So there are activity-based measures or non-activity-based measures. When I say activity-based, it means the P&L line items. It can be revenue, it can be profit. Or when I say non-activity, it means the balance sheet items. It can be based on the fixed assets. It can be based on the share capital. So again, the auditor should determine what basis he is going to use for calculation of the materiality. And one of the primary consideration in selecting the basis for materiality is what is most important to the users of financial statements. So suppose the financial statements for a quarterly review are being prepared, and for that particular company, the most important factor for the management as well as for the investors is the profit. Then profit should be used for computing the materiality. If the profit is not there, then next best activity based measure would be the revenue. And once the basis is decided, then he should determine what percentage of that basis should be used as a materiality. Say if the revenue is selected for computing the materiality, then whether it should be 1%, 2%, 5%. So what percentage he should apply on the basis to determine the materiality. So again, once he has determined the materiality, then he would be able to determine the nature and extent of his inquiry and analytical procedures. Now, the third thing which is covered in the standard is ordinarily auditor not required to test accounting records through inspection, observation, and confirmation. Yes, this is also one of the important aspects. So as a part of review procedures, we are not supposed to inspect the vouchers or obtain the independent confirmations. So it is not expected as a part of review procedures, but again, it can be assessed by the independent auditor whether he should perform these procedures. If he sees any particular risk in any particular area, then he should definitely do that. For example, for any particular entity, you are performing the quarterly reviews as well as the year-end audit. And for that particular entity, discount is one of the expense which is most critical. And if the auditor assesses that if he's going to audit, he's going to verify all the vouchers towards year end, then it would be difficult for him and he wouldn't have sufficient time to perform his audit procedures. Then as a part of his review procedures, he can build some procedures for testing some of the vouchers or relevant documents to verify that discount expense. So again, considering the need for that particular engagement, then he can decide what level of testing or what level of procedures an auditor needs to perform. The next is some procedures can be before or simultaneous with the preparation of interim financial information. Yes. So for limited reviews, in practice, generally, if there are big entities or big companies having significant volume, so for that, before closure of the quarter, so some procedures are performed before closure of the quarter and some procedures are performed after the closure of the quarter. So suppose if you are performing the audit of June quarter, then generally auditor take a cutoff of 10th June and perform the procedures, and for the remaining 20 days the procedures are performed in the month of July. This is because after the quarter end, after June, the auditor would not have the sufficient time to complete his review procedures. Then next is direct external confirmation, ordinarily not necessary, that we have already covered. And the last one is inquire management. If all events up to the date of review report that may require adjustment disclosed in the financial information have been identified. So again, the inquiry for the subsequent events, subsequent adjusting events should be made as a part of your review procedures. And the last one is if there is any change in the going concern. So if independent auditor is performing the review procedures, then as a part of his audit procedures, he must have performed the going concern assessment. He might have obtained the cash flow projections for the entity. And as a part of such procedure, he must have provided his conclusion in his working papers. Now, as a part of review procedures, he might take an update for those cash flow projections, so he can do the comparison of actual versus what was projected by management, and he can perform his inquiry procedures around it. So we discussed all this. Now, if we talk about the examples of such procedures, so first one is the auditor, as a part of execution review procedures, should make inquiries primarily for those persons who are responsible for the financial and accounting matters. So first, he should identify the persons to whom the inquiries should be addressed. And the second is he can perform various analytical procedures. Few examples are comparing the current period financial information with the immediately preceding corresponding period, or the corresponding previous year period. So he can perform the overall analytical procedures by making the comparison of current period with the previous or corresponding period, and can identify the material deviations or variances and can perform the inquiries around it. Then he can perform the comparison of actual versus budget, as I just said. For going concern assessment, if some cash flows were provided as a part of previous audit, then he can perform the comparison of such cash flows projections actual versus what was budgeted by the management. Then for the ratio analysis and trend analysis or statistical tools, so all these analytical procedures can be incorporated and performed by the independent auditor. Now, as a part of other review procedures, so these all have been discussed in detail while SRE 2400 was discussed. So inquiries and review procedures for the accounting estimates, inquiry and review procedures for the related party transactions, significant unusual transactions, fraud inquiries, subsequent events, then review of minutes of the meeting. So all these procedures can be performed as a part of the review procedures. Now, moving to the next slide, which is on evaluation of the misstatements by the independent auditor as a part of the review engagement and the management representations. So evaluation of misstatements. So if the independent auditor has come across any material misstatement in the financial statement, then he should exercise his professional judgment in determining whether this misstatement is material or not. And if he decides that it is material, then he might feel that there is a need to communicate it to the proper level of management. Then if he doesn't receive a response from the management, then he may assess that there is a need to communicate such misstatement to those charged with governance. And if again from those charged with governance also he doesn't receive any kind of response, then he definitely assess the need whether there is any need to modify the conclusion report. So again, he should consider all these factors while evaluating any particular misstatement. And the next one is, again, it is also a part of review procedures. The auditor should obtain the management representation. So for management representation, what he should cover in such representation. First one, the key and topmost point, the responsibility for design and implementation of internal control to prevent and detect fraud and error. So it is the management responsibility. So management should provide a representation to the auditor that the responsibility for preparation and presentation of financial statements and design and implementation of the internal controls of the company is of the management only, and it is not the responsibility of the auditor. Second is interim financial information is prepared and presented. This we discussed. Next is uncorrected misstatements aggregated by the auditor during the review are immaterial, both individual and in aggregate to the interim financial information. So, for example, during a review engagement, an auditor has identified misstatements and he has aggregated those misstatements. Now, for the auditor, in his work paper, he has requested management to correct such misstatements, but management has hasn't corrected it, and they are called uncorrected misstatements. Now, for the auditor, he would assess whether such misstatements are material or not. If auditor has concluded that these are material in his work papers, now he should also obtain a representation from the management that these are immaterial for the management also. Concluding in work paper of the auditor is not only sufficient to say that misstatements are immaterial. Now management should also say that such misstatements are uncorrected because these are immaterial for the management as well. Then the last key representation which auditor should take from the management is that all the significant facts and details have been provided to the auditor relating to any fraud or suspected fraud, and and if there was any fraud, if any assessment was performed by the management, then it has been shared with the auditor. Then next is if there are any non-compliances of any laws and regulations which is known to the management, that is being communicated to the auditor. And the last one is all significant events that have occurred subsequent to the balance sheet date, whether they are adjusting or non-adjusting, and the assessment around adjusting event or non-adjusting event, all these have been shared with the auditor. So these are the key representations which an auditor should take while performing the review engagement. Moving to the next slide, which is on communication with those charged with governance. So there are two cases which are given in the standard. One is this is on auditor's responsibility with respect to the other information which he has obtained as a part of the audit. So if he comes across any such information, say the bank returns or any other kind of information which auditor has come across as a part of his review procedures. For example, there are quarterly bank returns or communications which are made by the management to the bank, providing the level of inventory or the balances of the inventory. So if the auditor has come across any such information as a part of his review procedure, and if he finds any inconsistency between the interim financial information and such other information, then he should assess whether correction is required in the interim financial information or such other information. If the correction is required in the interim financial information, then he should request the management for correction, or if the correction is required in other information also, then should request management for the correction. And if in both the cases management refuses for the correction, then he should consider the impact of such in his review report. And if such other information contains any material misstatement, so first was on the inconsistency and second is on the material misstatement, that the difference between the balance reported in the other information and the balance reported in interim financial information is materially different, then in that case, again, auditor should discuss with the management and he should consider whether he need to modify his conclusion report. And the protocol he should decide in, before modifying the audit report, he should follow a proper protocol for communication of such misstatements. He should first discuss with the appropriate level of management. If no response from the management, then he should discuss with those charged with governance. And again, if no response from those charged with governance or no action is being taken from them, then he should then decide to modify, should assess whether there is a need to modify the conclusion report. So this protocol he should follow for each review engagement. Moving to the next slide, which are the types of modified conclusion reports. So first one is the qualified or adverse conclusion. So when there is a departure from the applicable financial reporting framework, then auditor should use the qualified or adverse conclusion. So the example of departure from financial reporting framework would be, suppose an entity is preparing the interim financial statements for 6 months period ended September for September 2022. Now in those financial statements, the comparative figures are not included and management refuses to include such comparative numbers. Then in that case, it would be called a departure from applicable financial reporting framework, because it is mandated by India's 34 that the comparative number should be given. for P&L as well as the balance sheet. So in that case, auditor should include a qualified and adverse conclusion in his review report. First, he should give the basis for such qualification or the adverse conclusion, and the next paragraph would be the qualified and adverse conclusion. Second kind of modified conclusion report is limitation on scope. So if there is a limitation on scope which is being imposed by the management to the auditor, then then auditor can assess whether there is a need to provide a disclaimer opinion or not. And the last one is going concern assessment and significant uncertainties. So again, if the auditor had performed the going concern assessment as a part of year-end audit, and now as a part of review procedures, he's comparing the budgeted numbers which were provided by the management in the previous audit to the actual numbers, and he comes across a significant gap between the actual and budgeted numbers, then he might assess whether there is material uncertainty related to the going concern. If there are certain measures available with the management and an auditor is satisfied with those measures, then auditor may assess whether there is a need to include an emphasis of matter paragraph in the conclusion report or not. Similarly, if there are significant uncertainties, so significant uncertainties can be if there are any litigations in which management is involved, and there is an uncertainty for such litigation. So there should be two factors in such a situation. First, there should be an uncertainty, and such uncertainty should be significant. For example, there is a company where there is a customer from whom a significant amount is receivable, and such amount is say 20% of the total assets of the company. So definitely it would be a significant number. Second, there is a litigation going on with the customer, and management bases its legal opinion believes that they would be able to recover such amount from the customer. But there is an uncertainty because the case is pending with the courts or other judicial authorities. Then in that case, it would be considered to be a significant uncertainty. So if it is a significant uncertainty, then auditor may assess whether there is a need to include an emphasis of matter paragraph in the auditor in the conclusion report or not. So these are the kinds of modified conclusion reports. So examples for such reports are available as an appendix to SRE 2410. Now moving to the next slide, the format of the limited review report. So in a format, there are various topics which an auditor should cover as a part of his limited review report, which are suggested by the standard, like title, addressee, identification of interim financial information, like for which period, for which entity such information is being prepared, what is the responsibility of management, what is the responsibility of the auditor, whether it has interim financial information have been in compliance with SRE 2410. Then very most important paragraph that this is a review and it is not an audit. So the procedures are performed are the review procedures, and the conclusion of the auditor, date of the report, place of the signature, membership number, and the firm registration number if it is a partnership firm. And the last slide, the documentation. So as it was told by Mr. Agarwal also, that work which is not documented is a work not done. So documentation is very much necessary because there are several inspections which have started to happen, and the basis of conclusion which an auditor has provided in a review report, he should have documented, and he should keep that documentation with him for a certain period of time as required by the ICAI rules. So this was on documentation. So this is all from my side. Anyone having any questions that we can take up?
चलो थोड़ी ठीक है brother.
Thank you so much, sir.
हाँ आ जाओ.
Thank you so much, sir. Can you hear me?
Yeah, I can hear you.
Okay.
Yes, sir. Thank you so much, sir, for sparing your valuable time. It was wonderful deliberation, and we have gained a lot through your deliberation. As I told at the time of the first technical session, due to the technical glitch, we haven't received any question yet. But we are trying to fetch the questions, and whatever the question we will receive relating to you, we will forward it to you through mail, and the answers will be forwarding to the concerned member.
Sure.
So in the evening or by tomorrow, we will forward the questions to you relating to your presentation. So on behalf of AASP of ICI, I extend my heartiest thanks towards you for sparing your valuable time and enlightening all our members relating to this SRE. Thank you so much, sir. Thank you so much.
Thank you.
Thank you. Namaste.